Chapter 10, Part 3, what happens if you have a zero interest purchase and what happens when you have a non-monetary exchange associated with tangible property, plant, and equipment. First, we'll talk about deferred payment contracts. The rule is you book at the present value of the consideration exchanged between the parties at the time of the exchange. So let's watch through an example. In our example, Danny Company purchases equipment on January 1st by signing an $800,000 5-year zero interest-bearing note when the prevailing rate is 12%. The company will pay off the note in $560,000 installments due at the end of the year. Now, whenever we're looking at present value, one of the first things we want to know is, first of all, what is the prevailing interest rate? We need the number of payments, and we need to know when the payment will be made, because depending on when the payment is made will determine which present value table we look at. Now, since this is multiple payments, we definitely would be looking at an annuity table. First, what's the journal entry when purchased? What's the journal entry at the end of year 1 and 2? And what is the depreciation at the end of the first year, assuming no salvage value and using straight line method for 10 years? So first, what we have to do, again, based on the information provided, is we're going to go to the present value table in Chapter 6, and we're going to look at the present value of an ordinary annuity. This is because the payment, again, is being made at the end of the year. We go across to 12% and then down to 5 periods and select the rate 3.60478. We're then going to take this times our annual payment of $160,000, and that will give us the present value of $160,000 paid over 5 years at 12% interest. Now we can do our journal entry. Equipment is going to be based on the present value. Discounted notes payable is going to be the difference between the $576,765 and the $800,000 that we paid, and the notes payable will be $800,000. Now we'll do an amortization table for year 1 and 2. Now year 1, the balance at the end of the year is $576,765 because we have made no payments. And so what we're going to do when we make our first payment at year end, we're going to take the $576,765 times 12%, and that tells us how much of the interest payment of $160,000 will be booked as interest expense, and then the balance is going to go against to reduce the principal. So now we have a new balance of $485,977. Our journal entry will look like this. Notes payable will be reduced by $160,000. Interest expense will be booked for $69,212. Cash will be $160,000, and discount on notes will be the $69,212. Next, payment. Again, what we're going to do is take the balance, which is now $485,977. We're going to take that times 12% to get our new portion of the $160,000 payment that goes to interest. The balance is then going to go as a reduction to the principal, and now we have a new balance of $384,294. Here is our second journal entry. Notes payable. Interest now is going to be $58,317, and our cash and our discount on notes is $58,317. Now, the method we are using here is the effective rate for booking interest expense. Now, what does our journal entry look like for our depreciation? It would be depreciation expense. We take the $576,765 divided by 10, and we would book accumulated depreciation. Now, what happens if we have a non-monetary exchange? Well, the rules are the fair value, we ordinarily account for it on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly more evident. Then we come to the concept commercial substance. And what that really means is when we do the exchange, does it change the revenue stream? i.e., can we now produce, if it's manufacturing equipment, can we now produce more units? Can we now generate more money? Most exchanges have commercial substance. And if they have commercial substance, then we don't have to worry about the gain or loss because we can recognize the gain or loss. Now, if something lacks commercial substance, then we're going to recognize the loss and defer the gain, except if cash is received. If cash is 25% or more of the fair value, then we can recognize the entire gain. If less, then we have to allocate it. We always recognize the loss. All right, here's our first example. And in this example, what if this transaction has commercial substance and the fair market value of the old equipment is $5,200 and Danny paid $10,000. Now in this example, we didn't get cash, we gave cash. So what do we need to solve this problem? Well, first of all, we need to know the life of the old equipment. We need to know if it has any salvage value. We need to know what did we pay for it. We need to know the accumulated depreciation. We need to know the fair market value of the old equipment and the cash, but most importantly, when did the exchange take place? Now, if the exchange changes the future cash flows again, then you book the gain or loss immediately. In this example, since we did the exchange during the year, what we have to do is make sure we update the depreciation. So since this exchange took place on April 30th, we need to book 4 months worth of depreciation expense. We're going to take the $11,200 minus the salvage value divided by 5 gives us an annual depreciation of $2,100, but we're going to take that times 4/12 to get 4 months of $700, and now we're going to book that depreciation. Now we can look to see, did we have a gain or loss on this exchange? So, in our example, again, the transaction has commercial substance, the fair market value of the old equipment is $5,200, and Danny paid $10,000. The cost of the old equipment is $11,200, less accumulated depreciation, which is the $6,300 plus the additional $700 that we booked. That gives us a net book value of $4,200, less the fair market value of the old equipment tells us we had a gain on exchange of $1,000, and since this has commercial substance, we can book the whole gain. Now, the first thing I always like to do is take the old equipment off the books. Then I book the cash. Then I book the value of the new equipment, and in this case, it would be the cash plus the fair market value of the old, and then I book my gain. Now, what happens? Same transaction has commercial substance, and the fair market value of the old equipment is $3,200. We go through the same process, and in this case, we end up with a loss. So again, we take the old equipment off the books, we book the cash, we book the loss, and now we have the new value of the equipment, which again is the cash plus the fair market value of the old. Now we have one more example. What happens if we purchase a new piece of equipment and paid $8,000 plus traded in equipment with a cost of $62,000 and accumulated depreciation of $20,000? It has a fair market value of $47,800 and lacks commercial substance. So the rule, you book the loss but defer the gain except if cash is received and it's 25% or more of the fair value of the exchange. In this example, again, we did not receive cash, we paid cash. So the cost of the old equipment is $62,000. We subtract the accumulated depreciation, gives us a net book value of $42,000. We take the fair market value of the old, and again in this example we have a gain of $5,800. Since no cash received and lacks commercial substance, you must defer the gain. So we try to come up with what's the value of the new equipment. In this case, the value of the new equipment is $55,800, but we have to subtract the gain, which means we can only book the new equipment at $50,000. So again, we take the old equipment off the books, book the cash, and then book the value of the new equipment. This ends this section.